India posted a current account surplus in the April, May, June quarter. This is for the first time in 17 years that we have posted a current account surplus. Now, the negative from this is that it has come from a very sharp drop in imports because of the economy's inability to consume. But the positive, some economists say, is that it makes it easy for the government to run up a larger fiscal deficit. Now, how is the fiscal deficit connected to current account surplus? And more importantly, will this current account surplus situation continue? To discuss these questions and more, I have with me three top economists and finance experts. Sajid Chinoy, Chief Economist at JP Morgan India, Samiran Chakrabarti, Chief Economist at Citibank India, and Anant Narayan, Professor of Finance at SPJIMR, SPJ Institute of Management Research. Gentlemen, thank you very much for joining me. Well, let me start with you, Sajid. What's the guarantee that this will continue? Is it a 1-2 quarter affair, or do you think this can sustain this current account surplus?
Morning, Lata. We think the current account surplus will sustain at least for this fiscal year and perhaps not beyond. And there are two ways to think about this, Lata. One is looking at proximate factors, and we find that exports have recovered faster than imports. Gold prices have come down, and you can say, well, therefore the current account is narrowing. But we must think of the current account more fundamentally, which is the current account surplus or balance of a country is simply the savings investment balance of the private sector and the public sector. And what we've seen, not just in India, but around the world, is the private sector savings investment balance has increased sharply in the last 6 months. Part of this is forced. Savings rates were forced to go up in the second quarter of the calendar year because households, on account of the lockdown, could not go out and spend even if they wanted to. But as the economy opens up, those savings rates should come down. But there's another force at play. To the extent that economic agents, households and firms perceive the shock from COVID to be quasi-permanent, you would expect that long-term consumption or investment could be marked down and savings rates could go up. So that's what's driving the current account dynamics. The first quarter was almost 4% of GDP. We think it'll get progressively smaller. The second quarter is tracking 2% of GDP, but we may well see a surplus for the next 2 quarters as well. Let me end by saying this is both a glass half empty and half full. The half empty part is that it's a sign of weak absorption or weak aggregate demand. And it also really complicates the central bank's management, because to the extent that we have a current account surplus of 1.5% of GDP for the full year, we project capital flows at about 2%. That's a balance of payments surplus of 3.5% of GDP. Now, at a time when inflation has been averaging almost 6.5%, growth is weak, the currency is perceived to be expensive, and you've got this, large BOP surplus. It exacerbates the trilemma for the RBI, because on the one hand, you don't want to stop.
Sajid, one minute. Sajid, 1 minute. Hold that thought. I'll come to the problems and the positives in just a minute. But you're reasonably sure that you're getting a current account surplus for the current year. Would it also extend to the next year at all?
Well, it depends on the pace of the recovery. So this year, we're quite sure, we're quite certain that we will get a surplus of 1.5% of GDP.
Yeah.
Next year, if the economy recovers faster and households have more confidence about the future, then you'd expect them to mark savings rates down. Okay. The longer the shock perseveres and the more uncertainty there is about the future, the higher will savings rates be for the private sector, and that should, all else equal, result in a lower current account balance.
Okay, got that, Sajid. Perhaps for the next year, the current account surplus is less likely, and it'll depend on the pace of the recovery. Okay, Samiran, I want to put the same question to you. 1.5% current account surplus for the full year is what Sajid is estimating. What's your estimate for the current year? And can it persist? Is it ephemeral?
Yeah, so Sajid has given a macro perspective on the current account. Let me go a little micro here, because that's also important, because ultimately current account is expressed in nominal terms. So certain nominal variables will also play a role in the evolution of the current account. And there, I guess, the critical assumption is about oil prices. If we expect that oil prices will stay in the $40–50 range for the foreseeable future, then that's definitely a positive for current account. And Sajid has obviously talked about the relative growth differential between India and rest of the world. That is another critical factor. But beyond that, I think two issues, actually three, which have kind of been very interesting. One is that the remittances have not fallen as much as one would have feared. In fact, there's hardly been any change in the remittance number for the April-June quarter. That has forced us to take up our whole year remittance forecast significantly upwards. The second factor is service exports. We never realized that how much growth would be there in the service sector exports this year. Given the situation of the pandemic, we were initially thinking that this could be even a negative number, but now it seems to be a positive number. So that has also cushioned the current account. And the third one is about travel. India will enjoy a bit of seasonality here, that in India, most of the tourist inflows are in the last 2 quarters of the fiscal, whereas Indians spend more on traveling abroad in the first 2 quarters of the fiscal.
Okay.
So while Indians traveling expenditure would be much less,
Yes.
India will get the inflows from the foreign tourists, hopefully in the last quarter of the fiscal. And that could also mean a bit of a upside to current account this year. So our number is 1.2% of GDP, which is pretty close to Sajid's, I guess. But next year, I think it will depend a lot on these nominal variables, gold prices, oil prices, etc. Our sense is that beyond everything else, is there an import protectionism that is at play, which will fundamentally reduce the current account deficit? That is a broader question.
Okay, yes, that is a broader question. But, Anant, do you think we should already start worrying about things like a Dutch disease? The problems of a rupee appreciation?
Well, Lata, not really. What we are seeing this year is a forced austerity shock because of the COVID situation. Just to add to what Sajid and Shamiran have already said, in the first 6 months of this year, our imports were down by $90 billion compared to last year. And that's because, as you put it, consumption and investments have collapsed during the COVID times. Now, this we know will recover. We're already seeing signs of the economy going back closer to where it was pre-COVID. So eventually consumption will improve, investments will improve, and therefore, given the nature of our economy, imports will go up. As both Sajid and Shamiran have said, this year will be a current account surplus. In fact, I have a number higher than the two of them. I think it will be closer to 2% of GDP, given all the reasons that Shamiran mentioned. Beyond that, FY22, of course, there are a lot of dependencies. Question is, how does the virus pan out? Is the virus finally behind us for FY22? Second is, I would watch the money supply very closely. If your virus is coming down, if the fear of the virus goes away and we still have this overhang of money, we could see demand come back and push current account back into a deficit. Third, of course, oil prices like Shamiran mentioned, and finally, how Atmanirbhar Bharat and our exports pan out over a medium term. FY22, I expect the current account surplus to be zero, maybe even going back into a small deficit. So therefore, the problem of a Dutch disease, not really. We are still looking at coming back to a pre-COVID kind of a situation where fundamentally we still need to do a lot more to improve our jobs and output and productivity. You have a problem of Dutch disease. You're producing too much and getting too much from overseas savings. That's not our situation at all.
Okay, I want one quick rapid fire from all of you. We have traditionally been a current account deficit country, and most of our economic policy is geared to that. Should that substantially change, or is this just an interval? Quick monosyllabic or single sentence answers. Shamiran?
I think we will return back to current account deficit. So fundamentally, nothing will change in a big way.
And yours
from a macro policy.
Okay, Sajid?
No, it'll be unhealthy at our level of development for us to run current account surpluses. I think we will and we should go back to current account deficits because that means we're actually importing capital from the rest of the world, which is what we need.
Absolutely.
So we should go back to current account deficits.
Yeah, we should go back, and your expectation is that we will, and this is probably a one-year interval at best.
That's right. That's right.
Anand?
What I would like to see is a return of current account deficit as far as overall is concerned, but accompanied by jobs and output, which means that we're producing a lot more of what we require. The import should be geared towards getting in capital goods and setting up production and supply facilities.
One minute. My question is much simpler. My question is, does current account surplus persist, or is it a one-year effort, one-year issue?
After 1 year, we go back to a current account deficit because the fundamental issues of our economy in terms of not producing enough domestic output still remains. But my point is, as we start to create jobs and output, and I hope we do that, the current account deficit might come down. Yet we need to counter that with importing capital goods so that we're setting up more jobs and output for the country. Right? So it's not that current account surplus is bad. We need a lot of jobs and output to be created, which means we need to be importing a ton of technology, capital goods, etc., to help create those jobs and output in India.
All right, got that. So the effort should be to improve growth and therefore get back to the deficit situation, which is the better situation. Okay, but you're clearly telling us that what will be the impact of the current account surplus situation. We're going to take a break and we're going to come back and ask exactly that. What is the positive and what is the negative of this 1 year of current account surplus? We are back in a minute. Welcome back. We have had a current account surplus for the first time in 17 years. I've been discussing with three finance sector experts and economists, Samiran Chakrabarti of Citi, Sajid Chinoy of JP Morgan, and Anand Narayan, the professor at SP Jain Institute. Whether they see it continuing, the answer from all three of them is that it is likely to be a one-year effort, provided, of course, we get our policies right. But what are the pluses and minuses for this year itself because of this current account surplus? That is more inflows into the country than outflows. That is the situation we find ourselves this year. Sajid, well, I read your research report and you think that this allows the government to spend more. Tell us what would be the advantage.
So the advantage here, Lata, the disadvantage, I think just 30 seconds we all know, is that it exacerbates the trilemma. You spoke about the Dutch disease. To prevent rupee appreciation, the central bank has to intervene, and that creates more liquidity, and that complicates its macro handling at a time when inflation is high and growth is below potential. What's the offset here? Let's go back to first principles. As I said, think of the current account as being a savings investment balance of the country. When you run a current account surplus, that means you've got excess savings. In a sense, what it means is the private sector's savings investment surplus is larger than the public sector's savings investment deficit. And what that means is this excess saving puts downward pressure on interest rates. Think of, let's abstract from money for a second. If we were producing widgets, we're producing 10 widgets, but absorbing 8 of them, the country has 2 excess widgets. That's our current account surplus. But because we've got this relative excess supply of widgets ex ante, it puts downward pressure on the price of widgets. Now think of that, think of what's happening to how the government has financed its deficit this year. 6 months ago, if we had to say that fiscal deficits would go up by 5% of GDP, the debate would have been, well, the RBI would have to monetize a large amount of this. The RBI has not. In the first 6 months of this year, April to September, extra borrowing by the government, GSECs, SDLs, and treasury bills has been 9.5 trillion. This is extra compared to the same 6 months last year. It's 5% of GDP. Guess how much the RBI's had to monetize? 1.6 trillion, about 15% of that. Because you've got this excess savings sitting in the economy. I'll just make one final point. This will mean that the market clearing price of government bonds gets impacted. Operationally, how does this work? Because savings are high, demand for credit is low. When credit deposit ratios in the banking system fall, the propensity to buy government bonds increases, and that means the market clearing price of bonds goes up and yields come down. So the one advantage is this acts as a safety valve. We've got these extra savings for this particular year, which means the government can finance larger deficits without having to worry about financing it non-disruptively or pushing up bond yields very dramatically.
Okay. Anant, your thoughts?
I tend to agree with the conclusions that Sajid comes out with, and I think he puts it well in terms of the transmission mechanism. I'm not a trained economist, unlike Sajid and Samiran, and I've promised to take tutorials from them separately. But the way I see it is the following. the total savings in the economy is a sum of the total government spending, the total investments, and the net exports, right? As the net exports goes up, the savings goes up automatically. The two go together, right? And we're seeing that happening, right? So I'm kind of uncomfortable with the funding sense of the benefit of savings, which is that my net exports have gone up, therefore my savings have gone up, and I can use that savings for government spending. I don't think it quite works that way. Anyway, it's an identity that net exports in the form of excess reserves in this particular case is funded or is matched by increase in money supply, which is savings in the system, right? So, but the way in which the transmission that Sajid has described absolutely works. And there is a minor positive and there is a major positive as well. The minor positive is what I think Sajid described. If savings goes up, it's in the form of money supply and deposits, then your interest rates tend to come down, and therefore the cost of borrowing for the government comes down. Mind you, when governments spend money, they create savings as well. They create money as well, right? So the cost of that borrowing does come down for the government. I think there is a major, even more bigger positive, which I think Sajid alluded to as well, which is that why does the government typically worry about creating too much of money? Normally, there are two worries that you have in your head. One is inflation, and the other is an external imbalance. If you have too much of rupees floating in the system, you could trigger off an external event eventually over a period of time. Now, if you have a current account surplus, which has been come about because of this forced austerity of reduced imports, that gives you a lot of degrees of freedom of not having to worry about the external sector at all. Otherwise, imagine if you're looking at double-digit contraction, huge problems in the economy, etc., you're looking at government deficits at 12, 13, 14% of GDP. You're looking at inflation being very iffy. We don't know how it's really panning out. You would really worry about a lot of things. FX, this one-shot surplus that we've got in gives us a huge amount of degrees of freedom for the government to go about and invest, spend money without having to worry about the external balance.
Fair point. Okay, now that makes it look a little positive from the government point of view. But Shamiran, I want to check if there is a negative over here. Both of you, in fact, all three of you have said that this is possibly an ephemeral, one-year phenomenon. Are we going to run up a debt to GDP, which will become very difficult in future years? Today we have a comfort, and so we overdo it, and will we have a problem later on?
So, Lata, before I answer your question, just 30 seconds on what Anand and Sajid said. I guess one problem that I have is that this is not an equation, this is an identity. It does not tell us anything about the causation, which is causing what. I'm somehow slightly uncomfortable in saying that a current account surplus is causing some comfort for the government. I think the bigger point is that because private consumption demand has declined so much, there is scope for public demand to go up and the overall demand in the economy to remain the same. That's basically what we are saying. Current account is, in my view, almost a sideshow. Although I agree with Anand that the exchange rate stability that we have witnessed in this crisis period, that wouldn't have been possible without the current account surplus. Now, on your public debt question, I think this is an area where, again, a lot of rethink is happening globally on what is the ideal level of public debt that an emerging market should be trying to achieve. I think we have blindly followed a number like 60% before. Is 60% the right number? That will get questioned. I think the critical issue is also how quickly we get back to higher nominal GDP growth. Because without nominal GDP growth being significantly higher than the interest rate, there's no way we will have a sustainable debt issue, regardless of what our fiscal deficit number is. So to me, it's important to get that nominal GDP growth right. And there I completely agree with whatever Anand was saying about the supply side reforms to get the jobs and technology, everything in place. So that's the broader point that I would want to leave on the table.
Okay, well, then very quickly, again, one monosyllabic or one sentence answer from all of you. This year we are going to run up a big deficit, and maybe the current account surplus is a reassurance, or at least one less bother for us while we run up this deficit. Do you think, Samiran, that our nominal GDP will be higher than our cost of funds. Our cost of funds is what, 6% now for the government average? Will our nominal GDP definitely be higher than that for a 5-year average?
Yeah, I mean, this will be higher than 6% for sure, but our calculation suggests that it needs to be higher than 10% to reduce the debt level down from 90% to 60% over a 10-year period.
Okay.
So that's the kind of hurdle rate that we have.
Okay, and you doubt that 10%?
That will require a lot of effort. That is not going to be an automatic thing.
Sajid, what's your sense?
Well, I just want to reiterate the important point that Shaumiran made, that ultimately, given our starting point, we have to underscore the centrality of medium-term growth for debt dynamics. I'll just give you 2 quick examples to make the point. I think whether we run a fiscal deficit of 2% more this year or 1% less does not matter. If we get nominal GDP of 10% for the next 5 years, debt to GDP will stabilize somewhere between 85 and 90. Even if you have a larger fiscal deficit this year. If nominal GDP gets stuck at 8% for the next 5 years, even if we are very restrained this year, debt to GDP keeps rising. So the focus has to be, how do you get trend growth back, which will solve a lot of things. Last 10 seconds, just so there's no confusion here. Everybody agrees the current account is a symptom. What the current account surplus is telling us is aggregate demand is weak, which allows the government to run stronger deficits without causing external imbalances. That's the simple point.
Okay.
And that's the shock absorber.
Okay, I'm told I'm running out of time, so I have to attend to the one question that I didn't, which is what will be RBI's problem if it has to absorb so much of dollars coming in this year, and it also has to help a fairly massive government borrowing program. So quick numbers here, Samiran. What is the extent RBI will have to buy in terms of dollars, and will that hamper its ability to further the government borrowing?
So our estimate is that second half BOP surplus is about $30-odd billion. That's about 2.5 lakh crores of extra buying if RBI wants to buy the entire amount. And then another 2.5 lakh crore of total OMO in the second half. So that's about 5 lakh crore of additional liquidity, out of which about 2.5 lakh crore will get sucked out through increase in currency in circulation. So we are still looking at about 2.5 lakh crore of increasing banking system surplus liquidity unless RBI finds different ways of sucking that out too.
Okay, what does that mean, Anant, in terms of macros? I mean, another 2.5 lakh crore will be floating around. Our inflation is at close to 7.
Lata, I'm going to answer your question in a different sense. There are 2 worries for the RBI. One is, of course, liquidity management. The other is what happens to financial stability and inflation particularly. And the 2 are different, by the way. Liquidity management, it becomes a problem if excessive banking liquidity, which, by the way, incentivizes banks to lend, leads to eventually high credit, which causes high inflation or coexists with high inflation. Right now, we don't have that problem. Credit growth is 5.5%. So liquidity is really not a problem right now. But if and when credit starts to go up and RBI worries about inflation, they have to suck it out. RBI and government will scream about it because it will cost them some money, but I don't think it's a big deal for the economy as a whole. Okay. The other thing I would worry about if I was an RBI is what's happening to money supply. And if the virus goes away, we are growing our M1 at currently 19% plus. Our M3 is 12 to 13% plus, could go higher. This is even without credit growth, right? Even eventually when we recover, credit growth comes in, this amount of money in the system can lead to inflation. So while we are hoping and praying that jobs, output, Atmanirbhar Bharat, productivity improves, which is, by the way, the one sole panacea for all our problems, if that doesn't come about, this overhang of money supply can cause inflation problems, eventually lead to imports and FX imbalances as well. 30 seconds or 10 seconds, Lata. Look, in FY08, RBI bought $94 billion, right? Between FY09 and FY14, they sold all of it back in the market. So while we are getting a lot of dollars right now, and these are permanent dollars because of our import austerity, things can change in 2-3 years' time, and we have to be careful, and RBI has to worry about that.
All right. Fair point. Gentlemen, I'm out of time, but that's a very enriching discussion. I'll quickly summarize. 1, current account surplus, likely to be a 1-year phenomenon, will start tapering definitely for FY22. We're not looking at current account surplus mostly. Advantage, it relaxes one worry for the Reserve Bank. Even if deficit and inflation go up, you don't have to worry that there'll be an attack on the rupee. Third takeaway, there is a debt to GDP problem. And unless our nominal GDP on an average for the next 5-6 years rises by 10%, we will have a problem servicing a fairly large debt that we are running up this year because of one reason, because of the relaxation in the external front. And finally, there is a lot of money that will be floating because the Reserve Bank has bought a lot of dollars, will buy a lot of dollars, and will buy even more government bonds, state and center. Now, all that money supply can exacerbate inflation unless we are very careful. Thank you very much, Sajid, Samiran, and Anant, for this conversation.